They waited for the highs, they waited for the crowd, they waited for the leverage to pile in, and then they changed the rules. If you're watching silver right now, you're seeing the same movie the market always plays at the top of a fast rally. A sudden air pocket, a waterfall candle, and 1,000 people asking the same question at the same time. Is it over? Silver was flirting with the 80s. Now it's bleeding in the low 70s. And the speed of it feels personal. It feels like betrayal. But listen to me. What you're witnessing is not a silver is dead event. It's a liquidation event. It's a margin event. It's a get me cash right now event. And if you don't understand the mechanics, you'll do exactly what this move is designed to force. You'll sell your position to someone who is waiting to buy it. So in this emergency breakdown, we're doing 3 things: fast, clean, and mechanical. What just hit the market in the last hours and why it looks worse than it is. The 2 paths from here, buy the dip versus bailout, with a checklist, not vibes. The levels and the next 72-hour regime map so you stop trading your emotions like a hostage. Because this isn't a chart day. This is a system day. Silver ripped, crowds chased, leverage crept in, then volatility spiked. The exchange responded by raising margin requirements, meaning more cash required to hold the same position. And at the same time, the macro tape turned slightly hostile. The dollar firmed, rates didn't magically loosen, and funds started locking gains after a monster year. So price didn't fall. Price got pushed. The real trigger, the CME margin hammer, the long squeeze. Let me translate the single most important part of today in plain English. On the Comex, most people aren't buying silver. They're renting exposure. They're borrowing volatility. They're holding contracts with a small pile of cash controlling a much larger position. That's leverage. And leverage is fine, until somebody changes the collateral rules. When margin goes up, a huge slice of the market faces one sentence: deposit more cash, or get sold. Not tomorrow. Not after a conversation. Now. This is why these drops look like a trapdoor. It's not one seller. It's a chain reaction. Here's the sequence. Step 1. Price pulls back from the highs. Step 2. Your unrealized loss grows. Step 3. Margin requirement rises. Step 4. Your broker demands more collateral. Step 5. If you can't post it, your position is liquidated into the market, and the liquidation itself pushes price down, which triggers the next liquidation, which pushes price down again. That's the waterfall. Margin. Forced selling. Price. More forced selling. This is why silver can drop hard in a blink after a parabolic run. It's not a vote on the future of silver. It's a purge of leverage in the present. The quick math, why this feels like a trap. Let's make it real with dead simple numbers. A standard Comex silver futures contract, SI, controls 5,000 ounces. At $70 an ounce, that's $350,000 of silver. You're not putting up $350,000. You're putting up a performance bond. And when those requirements rise, the math changes instantly. Imagine you have $35,000 in your trading account. Before the increase, you post margin. You have a cushion. Then the rules change. Required cash jumps. Your cushion drops instantly. Now add a fast pullback. If silver drops $3 while you're long one contract, that's $15,000 against you. You didn't lose because your thesis changed. You lose because you hit a math wall. And when enough people hit that wall at the same time, the market doesn't move down like an elevator. It falls like a trap door. Why the exchange does this, and why it always lands on retail. Now, to be fair, exchanges aren't raising margin for entertainment. They're doing risk management. When volatility explodes, the clearinghouse's job is survival. They raise margin so the system can clear trades even if someone blows up. But here's the uncomfortable truth. This protection mechanism always pressures the most fragile part of the market first. Who's fragile? Over-leveraged retail, oversized swing traders, anyone who added on the way up and was fine until the rules changed, anyone who didn't know what their contract actually controls. Meanwhile, the big desks, they can meet margin, they can hold through the puke, they can use the liquidation to enter, so don't take it personally. Take it seriously. Why it feels worse than it is. Options, plus stops, plus air pockets. There's another accelerator most people miss, option structure. When price drops through levels where a ton of stop-loss orders sit, you don't just get selling. You get selling that creates more selling, stops trigger. Algorithms lean into momentum, market makers hedge, liquidity steps back, and because we're coming off a fast rally, there's often a gap in the order book. Not many buyers between levels, because the market didn't build a base on the way up. So when it starts falling, it falls through empty space until it finds real bids. That's why your screen looks like a crime scene. It's not just fundamentals, it's microstructure. The miners are a lie detector moment, why they drop harder. And then the miners get massacred. Because miners are silver, with leverage built in. They're a higher beta expression. They amplify the underlying move. They get hit by risk-off selling, degrossing, and sell what you can behavior. So if you're watching miners down double digits while silver is down high single digits, that doesn't automatically mean the bull is dead. It means liquidity is leaving fast. And the key question becomes, does that liquidity come back or does it stay gone? That's what the next sessions decide. Why it hurts more. Thin liquidity. Plus, year-end rebalance. Now add gasoline. Holiday week. Thin order books. Fewer real buyers sitting there with deep bids. And then institutional behavior kicks in. End of year and new year portfolio rebalancing. Profit taking. Risk managers saying, lock it. So you get a market where selling is mandatory and buying is optional. That's how you get a flush. The macro headwind. Fed minutes plus the dollar. Why gold fell too. Now here's a key detail. This wasn't only silver. Gold dropped hard too. When gold and silver both get hit, that's a macro pressure event, not a silver mine supply event. And the macro pressure is simple. Hawkish tone, rates may stay higher for longer, dollar firms. Metals feel heavier. A firmer dollar is a wrecking ball for anything priced in dollars. It doesn't change the underlying shortage. It changes the financial conditions. That's why you see gold down, silver down, miners down, risk assets wobbling. It's not the thesis died. It's liquidity got expensive. So, buy the dip or bail out. The only answer that's honest. Here's the truth most people won't say on YouTube. There is no universal answer. There are two different games being played on the same chart. Game A, the leveraged short-term trader. Game B, the longer-term physical strategic holder, same candle. Two completely different realities. So I'm going to give you two checklists. Not advice, checklists. Because checklists remove ego. Checklist. 1. If you're a trader, leveraged or short-term, if you're trading futures, options, or leveraged ETFs, the only question is, can you survive the volatility? Ask yourself, are you near forced liquidation levels? Did margin rules just change again? Is the market still thin? Wild wicks, snapback spikes, gappy moves? Did we reclaim key resistance after the flush? Or are we bleeding under it? Can you hold the position without staring at it every 5 minutes? If the answer is no to survival, then you're not making a thesis decision. You're making a margin decision. And in trading, survival comes first. Checklist 2. If you're an investor, physical or unleveraged, if you are not leveraged, if you're holding unleveraged exposure or physical metal, the question becomes, did anything fundamental break? And this is where the market tries to trick you, because the chart screams, but the fundamentals whisper. Here are fundamentals that don't vanish in a candle. A. Industrial demand doesn't disappear overnight. B. Inventory tightness doesn't evaporate because your screen went red. C. China is tightening export permissions for 2026 to 2027 via a limited exporter list. D. The U.S. now frames silver as strategically important on its critical minerals list. That's not hype, that's structural framing. The trap, what this move is designed to do to you. Let me show you the psychological operation. Step 1, let price rip, get attention, trigger FOMO. Step 2, let retail pile in near the highs. Step 3, raise margins and tighten liquidity. Step 4, dump into thin markets. Step 5, trigger panic. Step 6, buy back lower, or at least reset positioning so the next run has fresh fuel. That's why you feel like you got targeted, because in a sense, you did. Not by some cartoon villain with a cigar, by a machine, risk systems, margin schedules, and liquidity dynamics. The levels that matter. Stop staring at the red candle. Now let's talk levels. I'm going to keep it simple. Support, $70. Resistance, $75.50. Why $70 matters. It's psychological. It's round number support. And after a run, round numbers become battlegrounds. If $70 holds and we start printing higher lows, that's not hope. That's a behavior shift. If $70 breaks clean and stays broken, then the market is telling you the flush isn't done. Why $75.50 matters. It's the line where you prove the rebound is real. You reclaim it and you pull the market back into uptrend resumption. You fail it and bounces get sold. But what about China? The long-term floor vests the short-term punch. Now, this is where the long-term bulls live. When a major industrial power tightens export permissions, it changes the psychology of procurement. Industries don't say, oh well, we'll just wing it. They say lock supply. And at the exact same time, we've seen an extreme east-west pricing signal, spot silver premiums in Shanghai surging to record spreads over London. That matters because it's the physical truth peeking through the paper market. When physical in one major hub trades at a persistent premium to the west, it tells you metal is wanted, metal is scarce where it's needed, and price discovery is stressed. It doesn't guarantee a straight lineup, but it tells you the fundamentals died narrative is weak. Physical vs paper, the simple test you can do tonight. Here's a test you can do without a Bloomberg terminal. If spot is crashing, but premiums don't collapse, that is not normal, because dealers don't reprice inventory instantly the way futures do. In a genuine demand collapse, premiums soften, inventory piles up. Dealers get desperate. In a paper-driven flush, the opposite can happen. Premiums stay firm, inventory stays tight, and the paper price becomes a temporary liquidity price, not the replacement cost. So don't just watch the chart, watch the street. The three regimes for the next 72 hours, no prediction, just maps. I'm giving you three regimes, not predictions, maps, because maps stop emotional damage. Regime 1, the V-shaped snapback. What has to be true? Forced selling finishes bids show up, sellers can't push it lower. What it looks like? Sharp bounce, quick higher lows, reclaim of $75.50. Volatility stays high, but direction improves. Translation, the flush cleared leverage, not demand. Regime 2, the dead cat bleed. What has to be true? Bounce is short covering, only funds keep trimming, the market keeps selling rallies. What it looks like? Bounce, then fade lower highs, repeated rejection under resistance. The tape feels heavy and exhausted. Translation, the market is digesting positioning and macro headwinds. Regime 3, the grind, new range, new game. What has to be true? Leverage is cleaned out, fundamentals remain constructive, both sides reset risk. What it looks like? Sideways chop, volatility, slowly declines, clearer support, resistance forms, patience becomes the edge. Translation, the market is rebuilding a base. What I'm watching, the checklist that calls the regime. You want signals? Here they are. Signal 1. Does silver stop acting thin? Thin markets print freak wicks. If we keep printing freak wicks, liquidity is still stressed. Signal 2. Do we see absorption at $70? Absorption is when price hits the level and buying volume shows up repeatedly. It's the market saying, I will take it here. Signal 3. Does gold stabilize? If gold is still sliding, silver won't get an easy life. Signal 4. Does the dollar stop climbing? If the dollar eases, pressure lifts. If it keeps firming, metals stay heavy. Signal 5. Does the Shanghai premium remain extreme? A persistent premium over London is a structural tightness tell. How the market hurts the most people, why it feels like a setup. Markets hurt the most people possible. Today, it hurt the longs by smashing price right after euphoria. Tomorrow, it can hurt the shorts by ripping their faces off on a snapback. That's the function. It's a clearance event. It clears leverage. It resets positioning. It reloads the spring. A word to the person panicking right now. If you're staring at red and your stomach feels tight, listen. Your brain is doing what it was designed to do, protect you from pain. But markets weaponize that wiring. They turn short-term pain into long-term mistakes. So do this. Step away from the screen. Breathe, and decide which game you're playing. If you're trading with leverage, your job is survival. If you're investing unleveraged, your job is conviction, based on facts, not candles. The buy the dip case, what would have to be true? The bull case is not I feel bullish. It's what would have to be true. Here's what would have to be true for this to be a buyable flush. The selling is primarily mechanical, margin plus profit taking. We hold $70 and start building higher lows. We reclaim $75, $50 within a reasonable window. Physical tightness signals don't vanish. Premium spreads remain firm. Macro doesn't turn into a full dollar wrecking ball. If those conditions appear, then yes, this is what dips look like in a bull market. Violent, unfair, and perfectly timed to scare you. And here's the bearish case without drama. To bail out, you'd want to see a decisive break of $70 that does not reclaim quickly. Repeated failures at resistance, every bounce sold hard. Gold continues falling and the dollar keeps firming. Physical premiums collapse, meaning real demand actually backed off. New margin hikes or new risk events keep forcing liquidation. That combination means the flush might be turning into a longer reset. The playbook, what to do with the next 24 hours. I'm going to give you a clean battle plan with zero hero mode. Battle plan A. If you're over-leveraged, reduce risk until you can survive. Don't argue with margin. Don't average down with borrowed money in a storm. Battle plan B. If you're unleveraged and you believe the thesis scale, don't swing. Have levels, not emotions. Decide your maximum exposure before the next candle prints. Battle plan C. If you're unsure, do nothing. Cash is a position. Clarity is worth more than a rushed decision. Why are they doing this? The system incentive. Here's the incentive nobody talks about. Exchanges are risk managers. When volatility explodes, they raise margin to protect the clearing system. Funds are performance managers. After a massive year, they take profits and rebalance. And when those two forces hit the same day, they don't care about your thesis. They care about their mandate. That's why it feels cold, because it is. In bull markets, the path is savage. Breakout, squeeze, margin, liquidation, rebound, rumor, rug pull, repeat. That's not pessimism. That's reality. And if you can't emotionally handle that path, you will not capture the outcome. If this breakdown is useful, hit subscribe, because we don't do vibes, we do mechanics, and we do battle plans. Drop a comment, team dip or team bail. Not because I'm taking a vote, but because it tells me where the crowd is, and the crowd positioning matters.